Hi, this is Dave Foster with the 1031 Investor. I'm so excited to be with you today. We're going to be diving into all things 1031, of course, because that's where I live. But there's some incredibly exciting things that have come down the pike now with the new big, beautiful bill and what that means for real estate investors. So happy you're here and looking forward to diving into it with you.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 526. It's tax season again, and with new updates to the 1031 exchange and Section 121 rules, now's the time to make sure you're not leaving money on the table. My guest today, Dave Foster, founder of the 1031 Investor and one of the nation's top qualified intermediaries, has spent more than 25 years helping investors use the tax code to build wealth and defer taxes. We'll talk about what's changed for 2025, how to plan smarter for your next exchange, and how to keep more of what you earn this tax season. Dave, welcome back to the show.
Hey, it is awesome to be back. Really, over 500 episodes. That's amazing. Congratulations.
Always good to have you back. And we've had several conversations in the past about 1031 exchanges. And I know that there's some new rules in the big, beautiful bill that the Trump administration did in 2025. Why don't you fill us in on what some of those are?
From the real estate investor's perspective, it's a gold mine. And as you know, we all lived through a pretty precarious time for the last few years, especially in 1031 world. We had an administration that was wanting to get rid of them, putting it in their budget every time. They were also wanting to change many of the depreciation rules. And with the new administration and the big, beautiful bill, I still can't have a hard time saying that with a straight face, but the big, beautiful bill, it's not so much that we're seeing changes, but we are finally seeing a cementing of the things that were available to us up until that election. In the 2017 and 2018 sessions, of course, then President Trump put into place bonus depreciation. He took away personal property for 1031 exchanges, but he gave us the bonus depreciation and cost segregation. So it's kind of like better for real estate investors, not so good if you were trying to exchange heavy equipment or airplanes or things like that.
When you say he took away personal property from the 1031 exchange, you don't mean like real estate property. You're talking about equipment and...
Correct. For the last 80 years, or almost 100 years, you were able to not only exchange in a 1031 real estate for real estate, but you could exchange other property as well. So we would do exchanges for airlines, for their airplanes, 747 airplanes, or heavy equipment for mining operators, or for large hotels, their furnishings and fixtures. The towels, the beds, the couches, and all of those kinds of things could also be exchanged tax deferred. So that was kind of good for that section. President Trump then, in his first administration, took that out so that now it was only for real estate. So you can exchange investment real estate for investment real estate. But when he took that out, took personal property out, he instituted bonus and advanced cost segregation for depreciation. So those owners of assets were able to get a much better depreciation rate. So it was good for them. They did lose the 1031 option. For real estate investors, it was kind of a non-impact. But Now, with the new administration and the new big, beautiful bill, he finally put those into play permanently. And that's been the biggest thing to give people a sense of comfort that 1031 exchanges are not going away for a long time, and that bonus depreciation is here. For our folks that are particularly in the short-term rental business or high net worth individuals that were using short-term rentals because it could be classified as active participation, they can now still feel comfortable that they're going to be able to take that same amount of depreciation because of the change. And that was just, there was so much uncertainty. People were scared to pull the trigger. Purchase of a short-term rental is a big investment. Am I really going to be able to get the depreciation off of that I need to go against my income for this year? Or is it going to get lost and stuck in that asset? So now that it's unlocked, those are the two biggest changes that are real estate specific. The step up in basis, though.
Let's talk about bonus depreciation, especially how it applies to short-term rentals. So explain give us the 101 on what bonus depreciation is. And then is bonus depreciation for real estate investing the same as bonus depreciation now for short-term rentals?
There's actually still, as you could imagine, we've got 7 or 8 million accountants in the United States, and they have 7 or 8 million opinions on what that means. But in essence, there's two things that work together. There is normally, when you buy a piece of real estate, you are allowed to depreciate that if it was residential over 27 and a half years. Now, that meant that the IRS was going to let you pretend that your property lost 1/27th of its value every year. And the good news about that was you could write that off as a loss on your income tax return. Now, bonus depreciation ramped that up dramatically to where now we're seeing that most people are thinking that you're going to be able to get 100% bonus depreciation in the year in which you buy the asset. So instead of only getting to take 1/27, you can take 100% bonus depreciation. Now, the other side of depreciation is what's covered by the cost segregations, where if for whatever reason you're not able to take 100% of your property's depreciation, you're able to sort of back out that building and turn it from real estate into a bunch of other things. Things like wiring, air conditioning equipment, shingles for a roof, wood for walls, and all of those things, so that those are then treated as property which has its own shorter depreciation schedules. And it really just kind of depends which is most advantageous for you, which way to go, because you'll still get the depreciation, but now with cost segregation and bonus depreciation, some really cool things can happen when you sell, because President Trump also left the 1031 exchange alone. And the beauty of the 1031 exchange, with both cost segregation and bonus depreciation, is that when you sell your property and do a 1031 exchange, you do not have to recapture the depreciation that you took or could have taken. So let's say you've got $200,000 in depreciation that you just wrote off. That was nice. You got the tax write-off, but now when you sell, the IRS wants you to pay that back at your ordinary income rate. That's just not very nice. So the 1031 allows you to keep that deferred. Where it works with the cost segregations is that the IRS now has finally said that if the property you purchase for your 1031 exchange replacement is substantially the same type. And by type, I would mean combination of wiring, air conditioning, shingles. In other words, pretty much typical real estate. For typical real estate, you also don't have to pay back or recapture that depreciation. So in both cases, real estate investors now have an opportunity to both take much more depreciation than they ever could have. And secondly, continue to defer that when they sell so that you can truly keep that at bay till you pass away.
How was bonus depreciation and just depreciation in general treated previously in a 1031 exchange?
Well, there really wasn't any bonus depreciation. There was simply depreciation schedules that were all based on the North American Industrial Classification Code. How's that for a mouthful? And what that really meant was that any type of property, whether it's a desk or a computer or a house or a commercial building, was assigned an NACC number, and that determined how long it could be depreciated over. So commercial was 27 and a half, or I'm sorry, residential was 27 and a half years. Commercial was 35. And that was it. This was an easy calculation for your accountant.
Go back to the first Trump administration, because that's when bonus depreciation first was introduced, right?
Right.
And at that point, how was it treated in a 1031? Like if you bought a property, and so this would have been 8 years ago when first Trump administration.
Time flies.
It does, yeah. It's like deja vu. And if you bought a property, you depreciated it, bonus depreciation 100%, and then you sell it a year later. What happened to that depreciation or that bonus depreciation? Did you have to pay it back?
If you did not do a 1031 exchange, you had to pay it back.
If you did not do a 1031.
Correct. So that part really didn't change. If you did do a 1031 exchange, that all was carried forward and deferred into the new property.
So that has just been kind of locked in now, right? It's not like it's that has changed, but it's been locked in. So we know that is now, like you can plan on that going forward, no matter who's president.
Exactly. And because it's been condensed into such a short time frame, people are using it as basically an in the current year fix. I'm looking at a tax bill. What should I do? I'm going to go buy a short-term rental and write it all off this year. I mean, it's got the opportunity, the potential to give people an incredibly huge tool to mitigate current year taxes, as opposed to looking at real estate like the slow cooker. Oh, as I add to my portfolio, I'm going to get to take 1/27 of each of these properties every year. Well, that was nice. But honestly, if you have a windfall, if you've been in a tech job and your company goes public, you get that big bonus, there's some tax consequences that can come up really fast. And the opportunity now to pivot and jump with some of that windfall into new real estate that you then bonus depreciate or cost segregate in that year is incredible in what it could do. But they had to be able to count on that. It's not going to change next year, is it? And now we've got some assurance as much as you can. Because who was it? There was a famous attorney once who said that no one's person, property, or liberty is safe as long as Congress is in session. So I guess we should caveat and say we think it's safe.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is health care for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
So give us a concrete example of how you've seen that play out and how someone has been able to use both bonus depreciation and a 1031 and the type of money they were able to save.
Well, let's stay with the short-term rental example, because that's the one where you're not limited in what you take because it's active participation. We all know that, and I'm sure you've watched this, the next hotspot for short-term rentals is coming up. We don't know where it is, but it's coming up. Ground zero for the last 15 years was probably the Smoky Mountains. The areas around Gatlinburg, Pigeon Forge. Number one, there was all kinds of great vacation spots with an incredibly, I don't know the numbers, millions upon millions of people that live within a 2 to 3 hour drive. So it had all the recipes to be great vacation rental. And then there was a fire in Pigeon Forge that destroyed all the rental stock. So all of a sudden, the investors saw opportunity and they flooded in. Well, so the early adopters made a ton of money. Here we are 15 years later. It's a little bit more difficult to find the hidden gems in the Smoky Mountains. But a few years ago, somebody uttered the words, Broken Arrow, Oklahoma. And so everybody flocked to Broken Arrow, Oklahoma. And after Broken Arrow, Oklahoma, it became Tampa, Florida. And people just domino right all over the country. The concrete example of this is someone, and I've got clients right in that spot right now, bought into a vacation rental in the Smoky Mountains a year and a half ago. They're not doing as good as what they thought they would because they looked at pro formas from 5 or 6 years ago that the old investor had used. And there's just more supply. Demand is leveling out, et cetera, et cetera. So they're going, Dave, I would love to go someplace else. Today it was a guy who wants to go up to the Poconos because he can buy more property at a cheaper price in the Poconos in upstate Pennsylvania. So, but his property in Pigeon Forge, he owes a truckload. That's an industry term, truckload of depreciation. I think he bought it for $700,000, and there was like $400,000 of actual real estate appreciation. So if he were to sell that right now, he would owe probably $90,000 to $100,000 just in depreciation recapture. Well, that takes away a lot of the money that he would need to go buy his next rental, doesn't it? So he's doing the 1031 exchange. So he gets to take all of that depreciation recapture, even though he's not making much on the real estate because he hasn't owned it for very long. But he's going to take that $100,000 tax bill and instead do a 1031 exchange and buy several properties, 3 in the Poconos. And that's going to allow him to buy these for almost cash and at the same time not have to recapture the depreciation. It doesn't go away, but it's put into each one of those 3 properties. So as long as he owns them, he's not going to have to do a 1031. If he ever decides to sell to go buy in Eugene, Oregon, because that's the next latest and greatest vacation rental spot, then he'll do another 1031 exchange. And the idea is that even if you take bonus depreciation that gets rid of all your depreciation, you can still keep it at bay. And here's the best of all. If you sold a property for $500,000 and you bought a property for $1 million, you get to not only keep the depreciation you took on that first $500,000, you get more depreciation to take on the purchase. So it's easy to daisy chain that deferred depreciation.
So explain that. So do you mean when you purchase the new property through a 1031, not only are you keeping your existing depreciation recapture at bay, but you're also getting the new bonus depreciation on the new property that you just bought?
That's exactly right. Every dollar you buy more than what you sold is a dollar of depreciation that you get to take after you buy it.
That brings into a new algorithm then when deciding when to sell and buy and how to do so. You were going to go into the stepped up basis in value, and I interrupted you, but is there something there with the new tax plan?
Well, again, it's just the continuation of it, because one of the things that the last Congress and president wanted was to get rid of that, because that would have allowed them then to tax assets upon a person's death.
Explain what you're talking about when you talk about stepped up basis or stepped up basis and value or value and basis.
The mantra in my industry, the 1031 world, is drop in or swap until you drop, or defer, and then die. And the reason for that is that when you die owning real estate, your heirs inherit that real estate at what is called a stepped up basis. They inherit it as if they paid market value for it on the day you died. So that property that you did the 1031 exchange into for $500,000, that's now worth $1 million. And remember, you didn't have any, you'd already taken $300,000 in depreciation. So that's $1.3 million in taxable income. When you die, your heirs inherit it as if they paid $1 million for it. So all of that depreciation disappears. All of that profit disappears. You don't pay it. Your estate doesn't pay it. The heir doesn't pay it. And that's how generational wealth gets started in a big way. And what the Big Beautiful Bill did is it cemented that as well. So that's still in place. So now people can make owning real estate an integral part of their estate planning. So rather than adding relatives to real estate while you're alive and losing that, or having to set up some complicated trust structures, simply own your real estate and die while you own it. And your heirs will get out of permanently all of the tax.
You just mentioned trust and complicated structures of owning real estate. Like, what is the best way to own real estate if that is your plan? If I want to leave my real estate to my children and have them get the stepped up value and basis and is it basis and value or value and basis?
Stepped up value and basis, yeah.
How should I own it? Should I own it in an LLC, a trust? What's the best vehicle?
Any type of entity where the heir is not seen as having an interest in the real estate through the vehicle can get the stepped up basis. So whether it's an LLC that you own your stuff in. Now, if your heir owns 50% of that LLC, then they're not going to get all the step up in basis only on that which you own. So that's kind of a limiting factor. There's another example, and I'll get to what my answer is, which is going to be a non-answer, but I'll try. So if a husband and wife own a piece of real estate and he dies, she gets a stepped up basis on his half. So it doesn't take away all of her tax, but she gets the step up basis on his half. Then when she dies, her heirs get the stepped up basis on all of hers. So it kind of depends on who's in ownership.
So if it isn't an LLC and I want to leave it to my kids, I don't want them in the LLC because I want them to inherit it without being owners originally.
Possibly not, yeah, because they're not going to get to inherit all of it unless maybe your intent involves succession and the LLC keeps going. Which is why the answer is, if there's 8 million accountants in America, there's probably 79 million attorneys, and they're all going to have a different opinion on what's the best structure. For simplicity, owning it as yourself or as single member LLCs that have only you as a member is the best way to own it, because it simplifies management. It simplifies giving it to your heirs in estate. It simplifies selling it and 1031ing it. But that's just for those things. You know, I can just hear the attorneys now flying around the room yelling at me, liability, liability, liability. Okay, I get it, but I'm not in the liability business.
Listeners should consult an estate attorney, their own legal team, to figure out the correct answer to that question for their particular situation.
Because if you can't shoot them, you ought to at least use them.
And we do not endorse shooting.
You know, that's sad that we actually have to say that now, but this is true.
So, Dave, what else is in this bill that solidifies and clarifies things for real estate investors or might be new and useful to real estate investors?
You know, this is something that someone's going to have to look up the numbers for me, because I do not remember the numbers, but I do know that the limits on estate that you inherit tax-free also were going to sunset, and they're not. They're now going up. But I cannot even begin to tell you the amount. That's a big deal, because that estate limit recycles every so many years.
Are you talking about the death tax?
Yes.
Which basically is up to a certain amount. And I think at one point it was 5 million. The heirs did not have to pay taxes on that. But after, but above that amount, whatever it is now, there's a tax bill that comes due.
And that always typically is at a sunset, so that that exemption disappears and it starts back at whatever that Congress decides. Now there's no longer the sunset. So they put that in permanently.
That's another thing that hits wealthy people, that wealth tax, because sometimes it can be high enough that it forces the heirs to sell the business or the property just because they have to pay the tax. So it's definitely something to talk about with your attorney and your estate planning.
Well, and interesting story. Most people don't know this, but that's actually why 1031 was started. It was put into law in 1920 for the specific reason that our nation was really hungry and it needed a strong agricultural economy. But people could not sell their farms because of the taxes they would have to pay. By the time they paid the taxes on the sale of their farms, they couldn't afford to buy bigger farms. So it was log jamming everything, because not only that, but think about the small guy who wanted to go into farming. There was no inventory. So 1031 was put into place so they could sell farms without paying that tax and use that to go buy bigger farms. And that changed the whole landscape. Now you and I get to do it on all kinds of real estate. It's a wonderful world.
So it was the farmers that led the way.
Exactly.
Dave, anything else as our investor, this is coming out in February, early February, our investor listeners will be sitting down to do their taxes soon. Anything else that they should be considering or thinking about as they do so?
Unfortunately, the first thing that comes to my mind is you're 2 months too late. In December, you could have bought that short-term rental. Or you could have bought that 6,000-pound truck to use for business. Or you could have bought that piece of equipment and used the 179 exemption to write it off completely in that year. So remember that for this coming December, because you're going to want to look at yourself, because that, between the bonus depreciation on real estate and the 179 on all the other types of assets, it's really possible to grind your taxes down to zero very quickly. If you've got now, I don't like to let, I even hate saying this, but the tax dog or the tax tail wag the dog. Is like, you don't do things just to get out of taxes. But if you're looking at expenditures, if you're weighing the purchase of a piece of real estate, the year before, the year in which you get those windfalls is going to be huge. But that being said, just a couple of things, and this is just Dave the investor, that you could do. Up your charitable giving. You got time to also, if it's February, you've still got time to contribute to your retirement accounts. And one thing that I'm doing, and are you familiar with the concept of a family office, Brian? Have you ever heard that term?
Family office plan? Sure.
It's always irritated me that it felt like, and everybody said, well, you've got to have 30 million to do this kind and 50 million to do this kind, and only Jeff Bezos can do this kind of family office. And so I started just like getting into that to help teach others and for myself, what's the difference? The difference is not the dollar amounts. The difference is simply in the structures and what they cost. So one of the key components of a family office that really benefits the ultra wealthy is their foundation. They create a foundation, and then that foundation, because it's a 501c3, is able to accept donations from who? From those individuals in the family. So if you've got a huge tax bill, and you're charitably bent, like, I don't like to give money to people just because I get a tax write-off. I want to give money to organizations and people because they need it. So a lot of what I give is not tax deductible. But my foundation allows me to donate to the foundation, and I get the tax deduction. And then my foundation is able to give to those groups and organizations and people that I want to, that otherwise would not be tax write-off. So I would encourage you to start looking at doing it, because everybody thinks of foundation, the Gates Foundation, it's just hundreds of millions of dollars. The cost to set up a small foundation to do exactly this is about $1,000. That's it. And now you're setting yourself up to be just like the ultra wealthy, but at your scale, whatever that is. Okay, so again, call your attorney and your accountant, but we're working on those kinds of things right now. And I like the potential that it's giving, because it's going to turn everybody into a giver. And that's just something that's close to my heart.
Very powerful. I'm glad you brought that up. I can't let you go, though, without asking you about the 179 and the Section 121 write-offs, because it's important, too, for tax purposes.
So 179 allows you to write off certain assets that you buy for business 100% in the year in which you bought them. So I have a son who's an optometrist. I bought him a $30,000 lens grinder. And I bought that for his business. I leased it to him for $1 a year. But I wrote off all $30,000 in the year in which I bought it. So he's got a lens grinder to use. I got a tax write-off. And he's got to use it for the next 20 years, because I don't want to have to recapture the depreciation. But I got to write it all off. 179 is used most frequently for trucks that are over 6,000 pounds. So all of us that love to drive big trucks, if we're using them for business, you get a write-off 100% of that. And as you know, they can get pretty expensive with a truck. It's another great tax write-off.
And is that just something that you fill out at the end of the year when you do your taxes, or have your CPA fill that out?
Yeah, exactly.
What's the 121 then? What's the difference?
So 121 is totally different, but it's the icing on the cake of the 1031. The 121, so 1031 deals with investment real estate. And when you sell investment real estate and buy investment real estate, you get to defer all the tax that normally would have been paid. Section 121 deals with your primary residence. So it's not investment, it's primary residence. But if you buy a piece of property, move into it, live in it, and then sell it so that you have lived in it for 2 out of the previous 5 years, then you get to take, if you're married, the first $500,000 of profit tax-free. And you can do that once every 2 years. So the difference is the 1031, investment property, tax deferred. 121, primary residence, but tax-free. And you can do it every 2 years. So the National Association of Realtors tells us that in general, you will live in 8 to 10 houses that you own throughout your life. That's 10 opportunities, potentially, to take $500,000 of profit tax-free. I mean, put that in another light. Over the course of your lifetime, simply by buying a house and living in it, you could potentially put into your pocket $5 million of tax-free income. It just doesn't get any better. And bugs the crud out of me. But you will hear a lot of very high-profile people saying, you should never own the house you live in. It's a bad investment. It's stupid. Well, in general, I think that most of those people would really prefer that you live in one of their rentals. But not going to pass judgment. But I'm just here to tell you that by buying a house and living in it, not only will you learn how to manage real estate, but you will be giving yourself tax-free income. That's the 121 exchange. That's huge.
Dave, tell our listeners how they can get a hold of you, find out more about you and 1031 exchanges.
Actually, it's almost 30 years ago now. Brian, how old am I getting so quickly? We realized that the greatest lack in all of this is information. The IRS isn't going to advertise it. Most accountants don't know about it. And I can say that because I am one. And my education was 1/2 of one class period in college. So the key for you to being able to manage and work well with 1031 exchanges is education. So we created a whole website based on just that. It's the 1031investor.com. I'm sure you'll put that in your show notes. And people have access there to calculators, to a 70-part YouTube series on all of these things that we've been talking about. They can set up appointments to talk to myself and my consultants. We tried to make it easy. The 1031investor.com.
Dave, it's always a pleasure talking with you, and you always bring so much value and ways to save money on your taxes and just really creative strategies. So I appreciate you coming back on the show, and you're always welcome back to talk 1031. So thanks so much for having this conversation today.
Great to be here.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.